Well, this market is stalled. Is there more upside in the equity markets, or do we turn here and head back down into the abyss? I brought Jim Welsh here from Macro Tides to discuss, the markets. And Jim, it's actually been a little bit quieter of a week this week, but volatility's come down a little bit. Things have calmed down a bit. Still a lot of mixed messages. Equities are just knocking its head up against that 5,500 level. What do we do here? What do we do, especially with such a big week of earnings, jobs
Yeah.
report, all sorts of stuff next week? What should we be doing?
Well, I think you trade smaller, first of all, just because as we've seen the last few weeks, a tweet here or there or a comment, has huge impacts on, obviously equities significantly, but, on all the markets. So I think we're in one of those environments where it's really easy to get blindsided. And when that's the case, trading smaller, I think makes more sense.
Yeah, I'd agree with you. Position sizing is going to be pretty critical around here. Keeping your stops a little bit wider so you can compensate for some of this volatility. But I mean, we've seen a 400 point S&P swing this week. I mean,
Yeah.
but I guess I know you're going to give us our charts, the charts that you bring and guide us
Yeah.
through next week. But do you feel like without giving it all away and talking about all the levels? I'm asking you right now, do we head higher from here in the S&P or do we go lower? What are your thoughts?
I think the odds are short term, we're making a high. We've expended a lot of energy to get to 5,500 and that resistance level. The market a couple of weeks ago was really oversold. That is completely gone. We're now modestly overbought. So to me, those two things, barring again some piece of news over the weekend,
Sure.
like yeah, we got to deal with China and Europe and everybody else, I think the odds are we'll see a pullback. The rally with today getting above and yesterday 54.81, and we'll go through the charts where it looks like okay, you can complete the first phase of a bigger bounce, and I think that has to be respected as opposed to we're topping here and we're going directly below 48.35. I'm not convinced that that's the case. I think one has to respect that. All right, short term we get a pullback. The nature of that pullback will tell us a lot. If it holds above 51.01, it keeps a move above 5,500 alive.
Well, Jim, you're gonna be going into the technicals, so
Yeah,
I don't want to dig too deep into this because I
yeah,
know I don't want it to take away from the charts that you brought. So let's just jump into it. Let's jump into
yeah,
the
yeah.
first chart that you brought.
Hey, it must be Friday.
I know I'm just mixing, making up new words as we go along. Let's talk about this GDP, first quarter GDP. Why do I even care about GDP? It's always backward looking anyway. Why
Yeah.
should I, as a trader, give a shit about this?
Well, I just think that there's some recognition of what's happening with GDP. And if you're just going to get an ordinary number, oh yeah, economy grew 2.1%, ho hum. But there's a realistic possibility that the GDP number is going to be around zero. Plus, it might be slightly positive, like zero point 0.5, or it could be minus zero point 0.5 or something, right? The GDP now from Atlanta Fed, I think, is more than minus 2%. The New York Fed is, I think, 1.5%. So you've got this one. So what's causing it, and we've talked about this, is when we import stuff, that subtracts from GDP because it's gross domestic production. So if something is produced overseas and then shipped to us, they subtract it from GDP. And as we know, imports have been surging the last 3, 4 months as people were, instead of beating the clock, beat the tariff. And not only that, in terms of companies that were ordering stuff, maybe responding to orders from consumers, they were shipping the stuff in as opposed to putting it on a boat and taking a couple weeks. They were shipping it so it showed up in 2 days. So to me, that chart on the left, that blue line is showing a sense of urgency of companies saying, not only when we want to get the stuff, we're going to pay extra to get it here quicker just because the tariff number at 20% or 10%, whatever the number is a lot more than paying maybe a 0.5% in additional freight costs.
Hey, Jim, I know it's on topic, but not necessarily have to do with your slides here, but you're talking about, all these companies ordering ahead of time. How much of a supply chain hiccup are we going to see due to tariffs, do you think? Just right off the cuff, I know you probably haven't done a lot of
Yeah,
homework regarding this, but
yeah. Well, if the longer it drags out, I think the supply chain issues become a greater problem. China said, okay, we're not going to ship you any rare earths. Well, all right. Once companies run through that inventory, well, what are they going to do? If you really desperately need something to make something, and you don't have it anymore, you're going to cut back production and temporarily lay off people. So that is the unknowns that we're dealing with as far as how long is this trade war going to last? The longer it lasts, it's like, are you dropping a small rock into the water or you stop, dropping a boulder? And the longer this thing lasts, it's going to look like a boulder, and the repercussions are going to be more significant. And to some extent, I'm not sure that we can, quantify it where we are today.
okay.
So, yeah, I think that to your point, that was probably one of the other motivations that companies had. Okay, we know tariffs, so let's get a bunch of stuff as we can in possible. And then for some companies, the risk of supply chain disruptions probably also added to that urgency. Let's get as much of the stuff in so we have a buffer window of 30 days or 45 days as opposed to 10 days. And so, these are known unknowns. Unfortunately, the unknown part is pretty large.
All right. Well,
Okay,
okay.
the chart on the right is inventory. So my point is, what'll happen here is companies get their stuff and then they show inventories. Well, as inventories grow, that adds to GDP. All right. And so to me, what's likely to happen is the first quarter is going to get dinged because of the imports. The second quarter could get a boost from the inventories. So if you're the Fed and other economists trying to get a gauge of, okay, exactly what's going on with the economy, all these cross currents are going to make it more difficult.
Okay. All right. Well, that makes sense to me. Hopefully it does, excuse me, to you guys at home as well. Let's take a look at the dark brown poop book, which is better known as the beige book. So I see that you have a lot of red here, which probably highlights the number of times these words were used. Is that correct?
Yes, that
Okay.
is correct. And so what we can see is uncertainty. There was a year or so ago, uncertainty had a high, and then it was gradually working its way down as we saw that the economy was still on decent footing. Also, the inflation rate was coming down. And then suddenly, over the last two meetings, you see uncertainty popping up big time, and tariffs and the impact you can see for a long time. The idea of tariffs were hardly mentioned at all, and now it's soared. And what does this mean for the Fed? Uh, I think it means they sit on their hands until they have more clarity about, again, how long all of this is going to last, the level of tariffs, uh, and how much that will add to inflation. President Trump's comments and criticisms of Chair Powell, to me, are just completely counterproductive. Because if you're going to say, boy, what an idiot, I'm thinking about firing him, he should be cutting rates now. And then you turn around and say, I really had no intention of firing him. I mean, my point is, if you're the Federal Reserve, you know that the Fed's independence is very important. I mean, they believe in that very, very strongly. So here's criticism coming from the Trump, and the Fed. I think Trump has basically raised the bar in terms of what economic data is going to prompt the Fed to cut rates. So, in other words, if we get some signs of slowing, but nothing conclusive, I think the Fed is going to be more inclined to sit on their hands for an extra 30 days, waiting for more definitive data showing because they don't want to look like they caved to Trump. Well, there's a hint things are slowing and they acted. Oh, Fed's lost its independence. So to me, I think what President Trump has done is counterproductive. He would have been far better off saying, you know what? I have confidence in the Federal Reserve. They will raise or they will cut rates at the right time and do the right thing And when they do that, I'm going to be very supportive of them cutting rates. That to me would have been the proper way to go about this. You're delivering the message, but it's being done in a way that's less market disruptive. I mean, it's hard not to look at what's going on and say, man, this is chaos. Markets don't like uncertainty. They don't like chaos.
Yes, they don't. And speaking of which, I'm sorry, I've got to. Did you just say markets don't like uncertainty and they definitely don't like chaos? Okay.
I
Yeah.
did.
All right. So the next it's interesting you bring this up. The next one you now I need to say something really quick. It was interesting just about an hour ago, after I came off of our Morning Edge show. I was reading Brent Donnelly's piece. He actually did statistics on, the magazine cover trade. He's been doing it
Ah,
for years. And I'll show you. I'll just do this real quick.
yeah, yeah,
Like I
yeah.
said, Brent is somebody that I've interviewed a bunch of times. He actually he's gonna I don't want to say up you one, but in his piece, he actually used yesterday's economist cover, saying only
Yeah,
1,361 days to go. He's obviously discussing the same thing you're discussing right here,
right.
except you're doing it for free, so there's that. So, but tell us about what this means to you.
Yeah, yeah. Well, again, covers on magazines, and it doesn't matter what the market is. In this case, we're going to be talking about the dollar. Covers show up after a trend has been in place, either for a fair amount of time, or the reasons for the trend are well understood. And it's at that point in time that a magazine wants to look like, oh man, we're really being smart here. And they plaster something on the cover. Historically, when you have a consensus that has become widespread and strong enough that it shows up on a cover, you're probably either near a high or you're near a low. And this goes back decades. I mean, I remember in the early, I think like 1982, no, I think the cover showed up maybe in 80 or 81, the death of equities. Well, equities have been going sideways for 15 years. And, a year later, the great bull market of 1982 began. So it isn't a precise timing, but it does provide valuable information to us who are following markets in terms of, all right, another sign that an extreme in sentiment is developing or already has developed. Now we're waiting for the cherry on top of the cake to be put. So to me, in last October, I showed the cover of the Economist magazine on the left and said, hey, this is exactly what I just said. This is telling us that the dollar's working toward an important high. And last week, it was how a dollar crisis would unfold. You know, I've heard more people in the last 2 weeks, Blake, and I'm sure you have heard them too, talking about, oh, there's a risk to the dollar's reserve currency status.
Yeah,
And,
right.
I don't know about near term, but longer term, oh my God. Well, the April macro tides, I went into great detail about why I think we don't have to worry about the dollar losing its reserve currency status because there are maybe four or five things that you really need. You need the rule of law, you need liquid and deep markets, you need to have a credit market, currency. You need so many things in place to become a reserve currency, and none of the BRIC countries have it, and so forth. So if somebody wants to get the April macro tide, send me an email, Jim Welsh Macro, I'll send it to you at Gmail. So my point is, we talked last week, and I'm like, and I saw this cover actually before last week. I just thought I'd wait because it came out last week. This is just more evidence to me that the time now should be spent looking for a bottom, for the pieces to fall into place for a bottom. It could be a week, it could be 2 months from now, as it was what we saw, last fall. They
Yeah.
were early by about 3 months, 2.5 months. So, again, as investors, as people who follow markets, you're looking for clues. And, it's tough time to quantify, well, just how extreme is sentiment getting? The cover indicator thing provides insight.
Well, maybe this next chart might provide a little bit of insights too. So this is the dollar positioning, which is really
Yeah,
interesting. You look at this year, the range that the positioning has gone from.
it's extraordinary.
It is
Okay.
really, really wild, right? I mean,
Yeah, it is.
talk about this, Jim.
Yeah. So again, think back the October of last year cover saying, the dollar is the envy of the world. And then you see this huge spike in positioning going into the end of the year and the first week or two of January. And people remember, we're all ramped up. Oh, tariffs are bullish for the dollar. Really? Oh, man. All right. So everybody got positioned for it. It ran, to 110 and change, and then puked. And now that all this has come out, people, oh yeah, man, the economy is terrible, or whatever the reasons are. I want to get short because the dollar could lose its reserve status, blah blah blah. All right, so the dollar made a significant low in July of 2023. That's like the right in the middle of that chart. So positioning hasn't become as extreme as it was then, but this chart is like a week and a half old. So my guess is the number could be even, lower, when it comes out, I think tonight, the commitment of traders report. So my point though is tying that in with the cover is like, this is hilarious. All right. They fell in love last fall and going into this year, and they were positioned for a big gain. Instead, they got a 10% decline. And now they're positioned for even more weakness. And
Right.
this is classic contrary opinion in terms of the covers telling us we're close to a low. Positioning now is also kind of saying, all right, the wrong way Corrigans are betting on it. So let's look at a dollar long term. So, what I'm trying to do is layer here when we're trying to analyze markets, what are the things we're trying to glean, right? And the cover being a piece of it, the positioning being another, the price pattern in the dollar when it peaked at 114.78, big decline to 99.59 in July of 23. And then you can see what I termed A, B, C up to that high in 110. And this pattern, when it was above 110, I'm like, this pattern, Blake, I think is completing. I think we're really near an important high. And then,
And
of
and
course,
and just for the record, I know I say this almost every week. I did not buy that argument. I wasn't there when we were up at these levels, and you're like, we're going to head back into the 90s. I'm like, yeah, I don't see it. And
yeah.
but we're here now.
Yeah, yeah. And so what we can see is in the big letters that are in blue. So we went from 114 to 99. I think that was a wave A. The A, B, C up to the high at 110 was a B. And now we've done 1, 2, 3, 4, 5 for a wave C. And so we're completing a correction from the high at 114.78. And what comes next is I think there's more upside than downside from here. There may be another point or two down in the dollar index, but I think there's at least a move back to 104 or potentially higher. And a move above 110 can't be ruled out either. All right. So again, the long-term pattern suggests this is the vicinity of a low. Look at the RSI. This is a weekly chart. The dollar's really oversold. Look where it was in January. It was really overbought. The high for the green wave A that you see around 107 and change, where the weekly RSI was. It was not quite 70, but it was darn close. So my point is the chart pattern, how oversold the dollar is, all these things to me say it's time to be looking for a trading low in the dollar index.
Well,
And
maybe you'll find it short term because this is your short term.
maybe. So again, the RSI at the bottom, you see it got down to 21, deeply oversold. And I'm not sure, I can't say with strong conviction that 97, 92 is the actual bottom. I think there's a potential that we get this bounce and there could be one more drop that takes out 97, 92 by a small amount before it's all said and done. Part of it is look off to the left. When the dollar bottomed at 100.1, you can see it was really oversold. It bounced and then it went to a very modest lower low there before we kicked off. I think there's a potential that we could see the dollar do some chopping around for a month or so, and at some point in time drop below 97.92. Um, Also, the 5 and 13 exponential moving averages haven't crossed, where the red's above the green. So to me, again, it's like, all right, I'm looking for a low, and I just, we'll see how it plays out in the next, handful of weeks, in terms of, do we get that one more drop? When does the red 5 expo move above the green 13 expo? But to be bearish to me, the dollar here is, I just think that's leaning in the wrong direction. I just think there's more upside for the dollar than downside from here.
That makes sense. Okay, the next chart you brought is gold, and you've been actually looking for a high in gold recently,
Yeah, yeah.
over the last few weeks, and we've
Yeah, 300 $300 ago,
yeah,
I thought,
but I mean, gold's
that
been
this is a
doing
blow
its
off.
gold thing. I
I
mean,
mean,
it
look at the
is.
move. Was that about 8 trading sessions or something? From 3,062 to 3,496. That's classic blow off material. Again, the RSI didn't confirm it, which is kind of amazing, I think, given the price move. So I think th has all the signatures of a blow off. Rally, 300 and some dollars or $400, and then reverse and lose 230 in less than 2 trading days. That's kind of a signature. I think gold is going to work its way down and tag that or get close to that blue trend line. But ultimately, I think gold's going to work its way down to 2,600. So it's like this process of, having a leg down, then there'll be a pretty nice sized bounce if in fact it gets down to near 3,100. My guess is that bounce will be a lower high, and then it'll break and make that move towards the 2,600. If and when it gets to 2,600, I think that'll be a really good buying opportunity. But, a lot will happen between now and then. Right here, right now, as I've been saying, I think selling into strength makes sense. Blow off tops are tough to anticipate, and they're just amazingly violent.
And that and violent is what it has been. So next, a lot of people are looking at the S&P here, and this is, when we started this today's show, really talked about that 5,500 level. It seems to be very, very sticky resistance here.
Yeah, it has been. And again, you look off to the left and you can see there was some, a low. The first significant low was 5,504. We bounced, we tried to hold it, broke down. We've tested it 2, 3 times now from the underside. As I said before, the market was very oversold. I have an indicator that looks at the 21-day net advances and declines. So it gives you an idea internally how overbought, oversold the market is. When it gets to minus 400, it's oversold. I think it got to like minus 550, really oversold back at that low with April 7th or 8th or whatever that was, right? Well, as of yesterday, it was over plus 300. So my point is we've used a lot of energy, from 48.35 to where we're at 5,500. And now the internals are overbought. And, in order to leap above this, you're going to either need, some positive news immediately to provide that extra boost. I think it's more likely, Blake, that what we'll see is a pullback so that this ABC up is either all of the rebound, so that's a possibility, and we are going to go directly below 48.35, or potentially this is ABC up for A. We're going to get a B wave pullback that holds above 5101, and then there'll be a C wave that can take it up toward that 50 above 5,700. Um, and the reason why, fundamentally, I think over the next 2 weeks or so, we're going to get announcements where President Trump says, hey, we've got a deal with Japan, or we have a deal with this country. EU and China, I think, are going to take longer. South Korea, and so forth. So my point is, I can see where we have a pullback, and then there's another push higher as we get the individual country trade deals are announced, and that provides support underneath the market. And so right here, I think we're going to get a pullback. the question is it a pullback to under 5,200, or is it like the beginning of the next big leg down? Right now, I favor the pullback that holds above 5,101, and that we're more likely to then to see another leg up. If that unfolds, Blake, I think I'll probably have high confidence and conviction that that will be a terrific shorting opportunity. But
If we
we're not.
do this.
Yes, yes, because I think that then is wave two. I mean, we may have completed wave two this morning. I mean, you got three waves up and, got a little bit above that 5481. But as I said, my gut just makes me feel that there are going to be some successes announced on the trade front. And it's hard to look at that as being negative.
And Jim, just as a reminder for next week, I mean, we have, if you look at the, Mag 7 or whatever, I mean, we have Microsoft, Meta, Apple, Amazon, Qualcomm earnings, Caterpillar, a lot of big
Yeah,
companies next week in the S&P. Plus, we got this jobs data, which is going to be the focal point of the market. I mean, there's a lot of things
yeah.
that could really move this market, whether you're talking about a move back down here or a move up here. There's a lot of things that can get us either direction, probably fairly easily coming into this next week.
Yeah, yeah, and the jobs number, we know about the government layoffs and so forth, but those who, basically took the voluntary, you know, leaving,
Yeah.
and they're getting paid through September. I don't know if it's September 30th or September 1st. My point is, there's some big numbers involved there, but if I'm getting compensated because I'm retiring, so to speak, I don't think I'm going to show. I don't know that I actually can go to the unemployment office and say I'm unemployed now. No, I'm getting compensated between now and September. So my point is some of the big announcements regarding, oh, they're going to close this and they're going to X amount of job losses, those probably will start to show up in the unemployment claims. But the people who took a package, I don't think they will. And I think there's a fair amount of those who did that. The unemployment claims continue to be hovering around 220,000.
Yeah,
So,
they don't look bad.
that is the thing that we all need to watch in terms of, okay, when is that bleed through going to happen? But the other thing is there's 160 million jobs. You lose a couple 100,000 government workers, that's kind of a blip. I think for the Fed's perspective, it's going to be when we see real private industry laying off people,
Yeah. All
because
right.
that means
Well,
that, all right, things are actually spreading out. We have this artificial thing happening in terms of Doge and closing things down and laying off people, but the overall economy is operating, if you will, so far it appears okay.
well,
It's
that's when
when
they're
we
going to
start
start
to
buying
see.
TLT, right, Jim?
Maybe, I mean, I think TLT has to close above 89.50. It continues to struggle, so we may just see this period where we just chop around here for a little while. And ultimately, once we see data that shows that the economy, in fact, is slowing more materially, then you could get a pretty good pop that takes it above 94.29 or 94.09, pardon me. It's critical that you hold those two most recent lows. Again, longer term, I'm bearish Treasury bonds. I think the 10 years going to 7.5%. So that decline that we saw into the lows last October, to me, is the first phase of a much bigger bear market. The rally to 101.64 either completed all of wave two or a part of wave two. And a few months ago, I thought, oh, that's just part of wave two. We're going to get a subsequent rally above 101.64. I'm just a lot less confident now because of the way we've seen the bond market react. The stock market dropped 20%, and bonds didn't really do a lot with that. Historically, bonds, there's been a flight to safety and quality where bonds really got a bid. That didn't happen. So to me, that makes me again concerned that the issue of supply, and obviously, it's hard to break apart the pieces. Oh, Trump is going to do all this with tariffs, and that's going to raise inflation, and that's going to keep the Fed at bay in terms of lowering rate. All these things are blending into each other. So I'm looking at the chart pattern. It needs to get above 89.50 for TLT to begin to look more constructive. In the meantime, I think you just see some chopping around. Um, And ultimately, I do think it's going to go above 94.09 before we get the next big leg down and big tick higher in yields. I just think we're going to chew up some time.
All right. Well, speaking of chewing up some time, we've chewed up some time today. And if you want to chew on
And
up
hopefully it was tasty and filling.
there you go. And if
The
you want to chew
Miller
up some more
commercial.
time with Jim, make sure you email him at what's your email, Jim?
Oh yeah, Jim Welsh Macro at Gmail. As I said, if you want the April macro tides, which did a deep dive in terms of the dollar's reserve status, currency status, I think you'll find that pretty interesting and informative.
Well, I think so too. And so make sure you reach out to Jim and tell him you saw him here. And make sure you subscribe to this channel so you can get these exclusive Friday talks that Jim and I have. I know a lot of you watch him over the weekend over a cup of coffee. And so you should jump down in the comments below and tell him how much you appreciate him. So Jim, thank you so much for joining us today and blessing us here at the Traders Summit. Blessing. And we'll hope you have
If
a
I
great
had some
week.
holy water, I'd be doing this, Okay. Well, have a wonderful weekend and look forward to doing more of the same next week.
We'll see you then.
You got it.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.